Thanks for clicking! Canada's bond yield, and therefore its mortgage rates, could be on the rise due to a weakening Japanese yen.
I didn't think that could happen.
Indeed, in a stark reminder that Canada's fixed mortgage rates aren't really up to our central bank, Canadian bond yields are now higher than they were 3 weeks ago, when the Bank of Canada cut interest rates, due, at least in part, to a weakening Japanese currency. And while we continue to see article after article on the lower borrowing costs that Canadians can expect now that the Bank of Canada has cut rates, sticky mortgage rates on, as we'll see, anticipated Japanese currency intervention tells us that things are not so simple. So what I want to do today is go over what's been going on in Japan, take a look at how that affects us here in Canada, and then discuss some implications. The end of the month is fast approaching, and with that we're expecting June's real estate data out from the local boards any day now, which will tell us if the market really did take off the minute the Bank of Canada cut rates.
What I meant was,
We'll obviously have updates out on that data on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into Japan. On to Japan, where the currency, the yen, has fallen to its weakest level since 1986. And as to why the yen is falling, down 12% this year alone, there are any number of explanations.
Not from me.
Some say the yen is falling as investors have scaled back their predictions of interest rate cuts coming from the Federal Reserve this year. If the United States issues the safest debt in the world and the Federal Reserve is going to be keeping interest rates higher for longer, then there's going to be more demand for US dollars to buy US debt coming from Japanese investors than there is demand for the Japanese yen. And this is very simple supply and demand. Japanese investors are going to have a greater demand for US dollars so they can buy US debt. More demand for dollars pushes up its value, less demand for yen pushes down its value. And that's where the problem comes in. That's what has Japan concerned, as when the value of a currency decreases, it raises the price of imports. It raises the prospect of inflation. And we've talked about this before at great length on this channel, discussing how far Canada's policy rate can diverge from that of the Federal Reserve before it starts to hurt our currency, before it starts to push its way into inflation. Though I do think it's worth briefly noting that the spread between the Federal Reserve's 5.25% and the Bank of Japan's policy rate of 0.1% is much bigger than the spread between the Fed's 5.25% and Canada's 4.75%. As such, Japan needs to get the value of its currency up, especially if this continues. But Japan's options are limited, due in large part to government debt. Japan's government debt currently stands right around 260% of GDP. And to put that into context, Canada's government debt to GDP is sitting around 60%, and US debt to GDP is sitting around 120%. So, given the massive amount of debt held by the Japanese government, were the Bank of Japan, the BOJ, to try to raise rates, that could be incredibly disruptive to government finances, as the government would have to pay a lot more to service its debt. Sound familiar?
Be my friend.
As such, if the Bank of Japan is going to be limited in how much it can raise interest rates, if it's going to be limited in how much it can increase the appeal of holding the yen, then the only other way to increase its value is to decrease its supply. Get the yen out of the market. And the way it does that is by buying back yen. Buying back yen out of the market using US dollars. And to get US dollars, it sells US Treasury bonds, of which Japan is the largest holder in the world. And at this point, it's worth briefly remembering that the price of a bond and its yield are inverted. So, as the price of a bond goes down, its yield goes up. So, as a brief example, say the US government sells a bond for $100 with a 5% coupon, meaning at that bond's maturity, the buyer of that bond is going to be paid back $105. But that buyer gets restless, sells that bond on the market early, sells it for $95, and the new buyer of that bond is still getting that $105. The price of that bond went down, but its yield, how much is being made off that bond, has just increased. That bond is now yielding 10%. And that's at least some of the reason why we're seeing bond yields spike, as investors are reacting to the prospect that Japan could sell their treasuries to defend the yen, prop up the yen's value. So, the Bank of Japan needs to increase the value of the yen, but it's limited in the extent to which it can raise interest rates, due in large part to government debt.
Smarten up.
As such, it needs to remove yen from the market, decrease the supply of yen, and it does that by buying back yen with US dollars. It gets those dollars from selling US Treasuries, putting US Treasuries on the market, which, when more and more Treasuries reach the market, that decreases their price, which will increase their yield. And as such, given that the US is paying more to service its debt, that means that Canada has to pay more to service its debt. And our own bond yield spiked as well. At one point, the yield on a 5-year bond had spiked even higher than it did following Canada's surprisingly high inflation read. Now, this doesn't necessarily mean that Japan is going to intervene into the currency market, though they have done it before as of recent, but the prospect that they might intervene into the currency market, that they might sell off treasuries to get those dollars to buy back those yens, to decrease the supply of yen on the market, was enough to send bond yields spiking. So, the yields on a 5-year Government of Canada bond, which influences fixed mortgage rates, are up due not to our own inflation rate, not to our Bank of Canada's policy rate, not even to the Federal Reserve, not even because of the United States. They're up due to a weakening yen. And I bring all of this up not just to demonstrate how inept our own media is at explaining how interest rates work, and then conveniently providing self-serving predictions based off those inept understandings.
I think he did it on purpose.
Despite what we know to be factually true, despite what we know to be demonstrably true, factual over and over and over again, that Canadian bond yields, which influence Canadian fixed mortgage rates, are far more influenced by global factors, by the US, in this case by Japan, than they are by Governor Macklem, the media continues to act though the bank cuts rates and people pile into real estate, sending a 500 square foot condo to $3 million by Wednesday.
When the supply gets low.
Except that's not how interest rate works. In this latest episode with Japan demonstrates that fact, where just the prospect of a currency intervention, not even coming from the United States, but rather coming from the Bank of Japan, is enough to send yields, and possibly mortgage rates, spiking. As this week's episode has shown, interest rates, the future of fixed rates, are much, much more complicated than the simple mood coming from Bank of Canada Governor Tiff Macklem. Yields are up this week based off potential actions coming from the BOJ, but they could also very well plummet next week on events occurring overseas. Now, I'm not suggesting that all potential home buyers need to take a look at what the yen is doing before entering into the real estate market. Not at all. What I am suggesting is that the future is as complicated as it is uncertain. What I am suggesting is to buy when you want. As we've seen today, the future path of fixed rate mortgages, the future path of bond yields, is incredibly uncertain and complex. As such, enter the market when it's the right time for you to do so. No one, and I mean no one, can predict what's going to happen with interest rates, with fixed rates, with bond yields, and therefore you should enter when it's the right time for you and your budget. With all that said, we will obviously continue to track Canada's bond yields and their effect on Canada's fixed mortgage rates on this channel. Click like and subscribe if you want to get those updates, but for now, thanks so much for watching.